Hey, what's up guys? Today I'm going to show you guys how to leverage a policy, either a cashback ROP option or a UL to allow a client to pay their mortgage off early and save a boatload of money in interest. If you guys have ran mortgage protection appointments for any amount of time, we've all ran into the clients that are paying $100, $200, $500 a month towards the principal every month to pay their mortgage off 5, 10, 15 years early, whatever it is. So if you guys know me, you know I love to use Americo's CBO 100 product for a mortgage protection policy because it just makes so much sense. You know, if anything happens during the life of the mortgage, if they're sick, disabled, cancer, heart attack, stroke, disability, pass away, boom, they're getting a check for the face amount of the mortgage. Obviously, they hope that they never have to use the policy, then boom, they get all their money back at the end of the mortgage. But what I do with some of my clients that plan on paying the mortgage off early is we'll actually put in place anywhere from a 15, 20, or 25-year policy to allow them to pay the mortgage off 5, 10, 15 years early. All right, so the first thing you guys are gonna need is a mortgage amortization calculator, okay? This thing's money. All right, so let's say they have a $250,000 mortgage. When they bought the house, they put 10 grand down, 4% down payment, and they've got a 5.6% interest payment for 30 years, okay? So on the app, boom, you type all that in, or you go to the principal. So you can see on here, the total amount of interest they're gonna pay for the life of the mortgage, just interest alone, is $257,000. All right, so let's cut that sucker down to a 20-year policy. So it looks like on a 20-year policy, the total amount of interest they're gonna pay is $160,000 versus $250,000. All right, so what we're gonna do on this side is we're gonna do the total interest paid. So a 30-year policy, like we said, $257,000. Cut that down to a 20-year, that's $160,000. So you're actually gonna save them 97 grand just in interest alone, paying off the mortgage 10 years early. All right, and then let's say to cover the full mortgage, CBO 100 for $250,000 is $200 a month. Then you're doing $200 a month times 12 for the full year times 20 years. That's 48,000. Okay. So in the CBO 100, if God willing, they never have to use the policy. 20 years from now, they're going to be getting 48 grand back from the CBO 100 tax free. Okay. You combine that with the money that they're saving interest. So you do 48,000 plus 97,000. That's $145,000 they're gonna save. Okay, so what you tell the client is you're like, hey guys, so I've got this product, very very simple. If you guys are sick, disabled, pass away, anything happens, even your family are getting a check for $250,000. Obviously, 20 years from now, we hope that you never have to use the policy. If you never have to use it, you guys are gonna be getting 45 grand back from the policy. And instead of paying that $200 a month towards the principal every month to hopefully pay your mortgage off early, what you guys can do is leverage that into a policy. So essentially all of your bases are covered. So anything happens, like we said before, boom, your mortgage is paid off plus some extra money, okay? Obviously, we hope that you never have to use it. You guys get 45 grand back, and then boom, you put that towards paying off the mortgage in one lump sum, 45 grand, and you calculate that and you combine that with the money, you just saved the client $145,000. So of course, there's some situations where just covering the face amount, whatever the face amount of the mortgage is, it allows them to give them enough money back at the end of the mortgage to pay it off early. But most of the time, you've actually got to put a bigger policy in place to allow them to get enough money back at the end of the mortgage. So it allows you to get a bigger sale, it allows the client to get more coverage, and it justifies for the client and it makes more sense. So instead of covering just the full mortgage, you're covering the full mortgage plus, maybe 3, 4, 5 years of the salary. And in order to calculate that, to allow them to effectively pay it off early and get exactly how much money at the end of the mortgage they're gonna need to get back, what you do is you pull out your handy dandy amortization calculator, okay? You extend it to the full 30 years of the mortgage. You hit calculate, boom, boom, boom. 20 years from now, let's say they owe $100,000 on the mortgage. You just pull out your calculator. I'm not good at math. So you do 100,000 divided by 20, divided by 12, boom. They're gonna need to pay $416 a month to pay their mortgage off 10 years early, in 20 years, or whatever it is. And instead of paying that towards the principal every month, it makes so much more sense for the client to leverage that into a policy. So if they're just paying down the principal and something happens, they're screwed. And that sucks, and they lose the house. But that way, all their bases are covered. They didn't have to pay any more money, and they're also saving a boatload of money versus having the mortgage for the full 30 years.